Good morning, everybody. Welcome back to Schwab Coaching. It's our Wednesday edition of Trader Talk in today's market. I'm your host, Kevin Horner. I am joining you from a beautiful Denver, Colorado. Lucky to be joined today by my friend and fellow Schwab coach, Ben Watson. Good morning, Ben. Good to see you once more. Hope your trip home from Denver
Kevin.
was a good one.
It was great, and had a wonderful time out there in Denver. I'll tell you what, that crowd was amazing. So whatever you're doing out there in Denver, Kevin, it's working. We had some phenomenal conversations with folks and some really encouraging responses to our 2-day live workshop there.
Yeah, I agree. Love getting together with the masses, the people, all of our, obviously our hosts in these workshops and Market Tribe events. Great one this past weekend. We'll talk a little bit as we set the table for you guys going forward. There's plenty more of those opportunities for those of you who have not yet been able to get out to a live event this year. But before we kick everything off, please say hi to our friend James Boyd there in the chat. Going to keep an eye on chat and all of you for us. Ben and I will do the same, of course. We'd love to bring your questions into the discussion. You are welcome to continue posting there for the duration of the segment. We do go about 45 minutes in total. Nice to see a lot of familiar names in there this morning, so thanks to all of you for being here. For those of you who are not already doing so, please follow the three of us coaches on X. You can do that for us individually at James Boyd CS, at Ben Watson CS, and at Kevin Horner CS. We would greatly appreciate that. And if at the conclusion of today's show you like what we do for you, we'd really appreciate a thumbs up on the screen down beneath the presentation window here. Now, some reminders before we get into the discussion. Our conversation is exclusively for your information and education. Simply put, we do not make recommendations. We are here to provide insights from a standpoint of education and the detail we're seeing on a day-to-day basis. Remember that options carry a higher level of risk and are not suitable for all investors. Make sure you review characteristics and risks of standardized options prior to any investment here, of course. And we talk technical analysis. That's our leading approach when we are looking at the broader market here, everybody. Remember to consider technical analysis a complementary viewpoint to the fundamental research we believe you all are already doing. Okay, in terms of our agenda, we get started with a broad market review. We take a look at the major indices, notably the S&P 500, the NASDAQ 100, and the Russell 2000. We'll also look at some of the tertiary areas of the market, including rates and perhaps volatilities, along with sectors, and of course, stocks in the news today. But before we kick it off, as I said, I wanted to remind you of all of what we've got coming up. We do have next events coming here over the next few weeks and months. If you'd like to see what we have on the table, you have an opportunity to come out and see Ben, who's very, very busy, as you can see coming up, everybody. Check the schwab.com/events calendar for us to get registered and attend the events that you're able to. We joke a little bit about it, Ben, but we love having people come out, especially if they build a weekend in, for example, Nashville, hanging out, but they build their weekend around an opportunity to come out and learn a little bit about the market with us.
Oh, 100%. And I'll tell you what, that Nashville event. That's the one I love all of these events, but that's one I am really excited about, because that is for the first time in about 5 years, we're doing an advanced options workshop. So coming back with that, which is amazing. And it's going to be a great opportunity. James Boyd, who's out there in the chat, contributed significantly to the content of that webcast or that workshop. And I'm going to have the great opportunity to teach that with our good friend Kevin Hinks from the Schwab Network, which is brought to us by our media production partner, Charles Schwab Media Productions, separate but affiliated company. But Kevin is a phenomenal presenter and a really good guy. And so that's going to be a fun event.
Yeah, I'm a little jealous of you, Ben. I know that'll be a great time. So hopefully everybody that has an opportunity maybe to come to one of these events, you get yourself registered. We sure enjoy hosting them, and I can say at least for Ben and me, we love being there with all of you, meeting, shaking hands, and having great conversations. It is a wonderful time for us. So thanks for being not only participating, but obviously being aware and coming out to these events, everybody. So with that, let's get down to what everyone's here for, Ben. Let's talk about what's going on in the S&P 500. Pre-show, we were talking a little bit about the continual grind higher, Ben. The S&P has, since the shift in interest rates, which is when we really moved through the range we've been in here, we've more or less gone higher, but we haven't seen these aggressive moves. It's just been a bit more grind, hasn't it?
It really has. You know, on Tuesdays, I teach a trading flag patterns webcast. And every Tuesday, we start by looking at the SPX. And I'm thinking, pretty much every time we've talked about it, it's been kind of at the cusp of a bull flag type of breakout. And yet it doesn't really break out significantly. It just kind of goes higher and it kind of grinds sideways, exactly as you said. The one thing that stood out to me, Kevin, as I've been looking at this over the course of the last few days, is the fact that while the SPX is making these higher highs, look at where the RSI is, that relative strength indicator. It's underneath, not that it's diverging, because it's following those higher highs, but it's underneath that, what we would refer to as the overbought line. So it's not at an extreme. So there's two ways you could look at that. There's less bullish pressure than there was in the May, June, July timeframe, where it was knocking on the door and into that overbought range. The other way that you could look at it is that it's not at an extreme, which means that there's more room for it to go before perhaps it gets to that extreme and potentially sees some rotation, Kevin.
Yeah, that's fair to suggest, Ben. And yet, if you're a trend trader, there's a lot of reasons just to kind of hold the fort here, isn't there? I mean, we continue to move above the 20-day moving average. Let's go back and see when we last recaptured it. It was back here on September 12th. So we are five and a half weeks already. If we get to the end of this week, it'll be 6 weeks essentially holding that 20-day moving average, which is about the window of time a move like this can occur, isn't it?
Yeah, exactly. I mean, you think about it in terms of not only earnings cycles, but kind of what's going on with rates. I mean, we've got a lot of things that are coming out, but we've got a lot of things that are kind of on that monthly cycle, right? We've got jobless reports, we've got CPI and PPI data that come on a monthly basis. We've got other things that kind of drive this market one way or the other that are playing into this. And I think now kind of we're into the biggest tranche of earnings over the course of this next week. That's going to have an impact. And
Sure.
Yet we don't really see any kind of cracks in this upward trend, right?
We really don't. And the last thing I'm going to say, Ben, as it relates to what we're seeing in the S&P is just I'm going to extend my horizontal support to the right here, just to highlight the confluence of notable level here at the 50-day moving average, right around 5670. Those of you who've been watching the show for a few months, you know what 5670 is, everybody. It was the peak we made back here in July, from which we retreated, pulled back, made that higher low relative to the last low. And then it's also our pause point before we retreated and had that huge hammer candle back on the September 11 day, Ben. And that was really the impetus to remind us the importance of horizontal support. Well, if the 20-day does get violated to the downside, it really calls out 5670 as an appropriate area for short-term support where we could very well find buyers rejoining the bullish bias, if you will, at the 50-day moving average. That would be totally within reason. And yet I have to point out from 5670 to 5830, we're talking about 150 point range there, Ben. So it's not a small move. It'd be about a 3% move from where we are today if we were to see it. Wouldn't be aggressive, wouldn't be over the top. But given the grind we've been dealing with, it is the kind of move that a trader is going to feel uncomfortable about in most cases, I would think.
Absolutely. And I think, you've got to take that into account. The other thing you've got to take into account is not only at the same time that the SPX is kind of making this grind higher, but we're seeing what we would traditionally call alternative investments, right? Things that supposedly move in a non-correlated way, like gold, for instance, continuing to blow the doors off of things, right?
Yeah, no doubt. Continues to do that. There's been plenty of that happening, right? It continued to make new highs. Got to continue to pay attention to that. Materials in general have made a bit of a pullback as a sector. We'll see here real quickly. I'll just kind of point out that pullback to where else? The 20-day moving average, not exactly an aggressive pullback, but a pullback. And yeah, we talk about this every the relationship aspect that is Ben. We try to kind of get an understanding of why things are maybe moving the way they are. So, today I think the walkaway is, hey, we're in consolidation mode in the S&P 500 up here, waiting for more data. Ben, there is one final reminder as it relates to the S&P, and that is that now that we are in this window, we are now less than 2 weeks out from the election. Is this when we can start to see some of that volatility come back into the market here? Are we seeing the VIX move, for example, which, of course, as a reminder, is a reflection of the S&P 500 put options on the indices? Ben, are we seeing a shift in the VIX as a result of this maybe 2-week window leading into the election?
Boy, you would think, right? I mean, we would think that maybe we would see some sort of lift in the VIX. Now, it's kind of hanging out realistically right about that 20 handle. Yeah. And the other thing that's interesting, Kevin, I don't know if you can put an overlay over the top of this. If you can put a comparison comparing VIX to VVIX. VVIX is the symbol that measures the volatility of the VIX, right? So
yeah, let's
looking at how volatile the VIX is, and that's falling too.
Is that a study, Ben?
Falling.
I can't.
Yeah, I think actually just do a comparison. Yep, and then put the symbol as, change the symbol to VVIX.
There we go.
Yep, right there.
All right.
VVIX.
Oh, I think I missed up that symbol. Yeah. Sorry. Let me get that.
Ah, there you go. Yep, no worries. VVIX.
There we go. Okay, just want to make sure I got it right. Hit OK. Yep. Did it hold? It did. All right, apply. Okay.
And it kind of skews. So, but okay, so you can see where volatility is down at the bottom. That's the VIX.
Yeah.
Right? Volatility is hanging out down on that 20 handle. The volatility of the volatility is falling as well, and that suggests that there's not a lot of kind of uncertainty. Now, that being said, this is the 30-day average of volatility. If we were to start to maybe change that time frame a little bit, it does change a bit. But boy, Kevin, you would think in this scenario that we would start to see VIX rising generally. Yes. Now, we have, to be fair, there's a little bit of a lower or a higher low scenario here, but it's not spiking yet, right?
Yeah, it really hasn't. And yet I'm hearing chatter, if you will, Ben, that this is something that people are monitoring because look, we all have expectations. They don't always play out the way we expect them to, but the expectation perhaps is to see a little bit more volatility. And then, of course, Ben, our last reminder as it relates to volatility is that volatility does not mean down per se. It doesn't necessarily mean negativity. It just means exactly what it suggests. Volatility, more action and broader ranges in all likelihood.
Absolutely.
Keep that in mind. Okay. So there is at least an interesting look at things. I'm going to go back in and hide this study. I'm going to actually keep it so that I can utilize it later, but I'm going to hide it there. Ben, let's go back to the major indices, checking out the NASDAQ 100. I got more than a few lines drawn in here, Ben, but the reality is everything we talked about with regard to the S&P from a trend standpoint remains pretty much the same in the NASDAQ 100 as it relates to the 20-day moving average in orange.
Yeah, absolutely, it does. I mean, kind of going sideways, rolling off that 10 or that 20-day, and just kind of staying right up there, right around that resistance level, and not really breaking out. RSI doing something similar. It's lower than the overbought line, kind of hanging out there, not dropping off. Although maybe in the last couple of days we've seen a bit of a bearish divergence, but it's very, very slight, hidden perhaps divergence, if anything. And maybe just kind of reloading against that. You see that kind of ascending triangle pattern building there in the RSI, which doesn't necessarily work the same way that an ascending triangle does work in price action, but it does suggest that sentiment is kind of narrowing its focus here.
Yeah, and I think while we love the idea of the ascending triangle, the truth is, as long as that RSI were to make a retreat to the mid-range on that RSI. Remember, the RSI is a banded indicator. It sits between 0 and 100, but ultimately the levels we pay closest attention to are over 70 and below 30. But in an uptrend like this, Ben, a lot of traders are going to look to see if the pullbacks in the price action are in line with pullbacks in the RSI into that 50 range, basically 45 to 55, which is for an uptrend, an area or a zone where a trader might suggest, hey, a pullback to 45 to 55 suggests oversold conditions in an uptrend, whereas in a sideways trend, those oversold conditions are just black and white. Oversold is under 30, overbought is over 70, Ben. We make some adjustments when we're looking at strong uptrends, though.
Yeah, for sure. Because again, we know that those extremes, and that's why I don't necessarily like the words overbought, oversold, because they tend to be, I've said this before, they tend to be pejorative, right? Because they tend to suggest, well, if it's overbought, it can't get bought more. And if it's oversold, it can't get sold more. And that's just not the case, right? I mean, we can see prices up in those extremes. We can see sentiment up in those extremes for a long period of time.
Yeah, good reminder, Ben. One thing we know is that overbought can last a lot longer than we expect, just as oversold can last a lot longer than we expect. So, yeah, we have some areas of import. If you're a short-term trader, we're continually watching that 20-day moving average for the near term and watch that 50-day kind of get caught up into that last peak that we had here in the mid, which was kind of important to get through. So look at where it is now. It's basically equal to the last low we made. So we're getting a lot of confluence. This is all relatively positive, but I continue to point out these levels beneath us for a good reason, everybody. If you're looking for a way to set your risk, an area under which we need to start making some alternate decisions, well, that's why these moving averages are applied to these charts. Just remember, they are there to give you the lead into the so-called if-then statement, Ben. If this occurs, then I need to do something. Hopefully, you're laying all that out for yourself in advance, right?
Absolutely. Gosh, Kevin, it's almost like you were at the workshop in Denver last weekend, right?
Almost. Yeah, exactly. So, Ben, as we kick on over to what's going on in the Russell 2000, we're only off 0.25% here, but we've made a pretty significant pullback after running ourselves right into resistance with that last peak of last week, didn't we? Right to the same ledge, almost right to the same level, almost to the letter. A pretty good move.
Exactly. And then selling off. And I think, again, this is partly a function of the fact that the Russell is, we know because of its exposure to financials, also its new exposure to technology post-June, right? That it becomes a little bit more interest rate sensitive when we see those rates, as we talked about at the top of the show. When we see those rates rising, that's going to have a direct impact on the Russell 2000. Now, we're going to kind of come right now into, I think, this week, the biggest tranche of some of those regional banks that fall within the Russell 2000 as they report earnings, and that may have an impact, may already be having an impact on what's going on here with the Russell 2000 as we see, banks like Zions Bank Corp, based here in Utah, by the way, report some pretty decent earnings, although they kind of split the bill here, went down and then rallied and were bought up pretty quickly.
Yeah, that's one of those charts that stands out, Ben, when you see what it's done since breaking its downtrend. We talk all the time about you teach the flag patterns, I teach the breakout patterns broadly, and moves like that in particular, are notable. Broke the downtrend line, took a little breather, maybe a trader or two employed something like the Horner rule, looking for confirmation of the breakout through the downtrend line, and then it just rallied and took off. And then took a brief pause at the peak there yesterday, but more of a continuation of the uptrend that's been in place for a while here. That little consolidation after the breakout gave more than a few traders an opportunity, perhaps, to participate in advance of that earnings announcement you called out.
For sure. And I think you're going to see some of those echoes throughout the rest of kind of that financial subset of the Russell 2000 as these rates push higher. And again, there's two forces at work, right? So you think about the banks that are kind of the top line, kind of the money center banks, the headline banks, if you will, the Goldman Sachs, the Morgan Stanleys of the world, the Wells Fargos of the world. And while they have a significant retail impact, they maybe don't create as much of that retail impact as these regionals, right? I mean, typically you see a lot of mortgages being held by a lot of these regionals and the credit unions and those types, right? So those interest rate impacts are going to come home to roost. That's again why these are so much more sensitive. So we see things like, the expectation was that mortgage rates were going to go down with interest rate cuts, and they haven't, right? We've seen mortgage rates increasing, in some cases relatively significantly. We've seen these longer term interest rates rising again as an expectation of greater risk. So it's really kind of an interesting scenario that the Russell 2000 and these regionals are stuck in here at this moment, Kevin.
It is, and yet, Ben, we continue. So now we've got a little bit of a 5-day pullback in the small caps and a continuation in the yield move over the last 5 days. So you see the 5 days, we had Russell meet resistance, pull back to its 20-day moving average. Well, here we've got the 10-year yield continuing its assault higher. My goodness, taking out the 200-day with conviction today, yesterday closing above it. And breaking the downtrend line that we broke late last week here, Ben. This certainly the move we've seen off of this is kind of having a negative impact on the Russell, I would assume.
For sure. Okay, so think about it, right? These regional banks, and to those that are saying, well, wait, I don't get that relationship. These regional banks lend money. And when that rate to lend money, either through mortgages or through personal loans or whatever else, when that goes up because of what the Fed is doing and what the 10-year yield is doing here, that becomes significant in terms of their inflows of capital, right? Because retail borrowers aren't as likely to borrow when those rates are higher. Auto loans, credit cards that are issued by those banks are influenced by this 10-year. And so that becomes a significant issue in terms of their revenue flow, their income stream. At the same time, they don't have as many assets under management necessarily or under investment as the money center banks do, where they're gaining more capital on those higher interest rates. And so they're kind of suffering on both sides of that rise in those short-term rates or short and intermediate-term rates.
So, Ben, is this something what are our thoughts now? We've made this significant of a development in rates, right? This is kind of, to a lot of investors and traders, going a little bit opposite of expectations. The move upward in yields has been on the heels of the Fed's decision to cut rates. So was the move that took us down to 3.6 all on anticipation of the rate cuts? And then since the rate cuts, has this been a move of traders covering those viewpoints and sending the yields a little bit higher?
Sell the rumor, buy the news, or depending on what you're doing, which is driving the bond prices, which is buy the rumor, sell the news.
Right.
And it's exactly right. I think that's the perspective, right? And not only, remember, a lot of this debt, a lot of this treasury debt that drives the 10-year is held or was held previously by other sovereign nations who have suffered from their own interest rate challenges. Inflation, interest rates, those aren't just a U.S. thing. Those weren't just happening here. They were happening elsewhere. And we've seen changes in the ECB. We've seen changes in the Bank of England. We've seen changes in the Bank of Japan. We've seen changes in the Bank of Canada that have also driven those moves in interest rates. So if they're selling off U.S. Treasury debt, well, then you're going to see the rate rise. That's what happens.
Yeah. And I guess what we need to caution ourselves against is perhaps assigning a narrative to the reasoning behind it. Maybe we just want to keep an eye on the actual moves as opposed to saying, well, hey, they're selling treasuries, therefore the U.S. economy can't be as strong as we thought it was. That might not necessarily be the case. There could easily be other mitigating factors there playing, kind of wreaking havoc, if you will. But it is sending yields
100%.
up. And we've seen a significant development, Ben. We are up 60 basis points since the Fed cut rates over the last month. That is a significant move.
And at the same time, we're seeing what we're seeing on the SPX and the NASDAQ continuing to rise. And here's the thing. Again, let's go back to this and then kind of, I think we've kind of beat this dead horse a little bit too much. But at the same time, so think about this. SPX, NDX are rising. 2 weeks out from an election. But in the past 8 years, we've seen two different administrations, and we've seen the market do well under both of those administrations. And so I think it's kind of 6-5 and pick 'em as to what happens to the market regardless of the outcome of this election. We don't get into politics. We don't talk about it on the Schwab network. We don't talk about it in our webcasts. But at the same time, elections create uncertainty. But as my good friend Sam Stovall says, elections and politics are market Valium, because it creates that possibility that the market can be two-sided, and that oftentimes will let the market rise in the absence of definitive policy push one direction or the other.
Yeah, that's fair to suggest. And as George in our chat is pointing out, political gridlock's actually great for the market. That
100%.
eliminates or reduces uncertainty in the marketplace.
Yep.
And that gives the big dollar investors, the deep pocket investors, our hedge fund managers, our ETF managers, our so-called smart money, it gives them confidence to deploy big chunks of assets over time that can give us continued lift. So it's a good reminder, Ben. That's why we have these shows. That's why we talk about this stuff all the time. We try, we certainly aren't telling everybody how to be approaching the market, but we are hopefully giving you various things to keep an eye on that can give you the follow-through reasoning to take action if you need to in any given scenario. Ben, we're going to do a quick hit on the SOX here. There's not a whole lot to keep a close eye on. I do think it's notable that we tried to break out here, did not occur. And what we've done is just kind of make a higher low to this point. Is there anything in particular you're watching on the semis here?
Boy, I tell you what, again, this is what Pat Mullally and I used to call a milquetoast ascending triangle, because you get this big rally up, you get a pullback, and then it starts to create this resistance shelf or ledge, as you call them, exactly, right around that 5,400 mark in this case. But the push up and the potential breakout of that resistance isn't necessarily indicative of this making new higher highs, but maybe a return back to that previous high, in this case up around that 6,000 mark, right? Mm-hmm. On that level. So milquetoast in the sense that it's not driving significantly higher to new highs, it's just simply driving back to previous highs and previous areas of resistance.
Yeah, the hope is that what we've done is just kind of pull us back to a short-term spot where you're going to see buyers stepping in and redeploying assets. But and I think the takeaway here is, hey, you got a higher high out of the RSI when it traded up there. We've pulled back. So it was clear that we weren't ready to continue on, but at the same time, we haven't broken down, right? We've just found an area where hopefully support is coming into play. Buyers are feeling more confident and more comfortable. We'll have to keep an eye on this one, as we always do, because the semis are very, very important to the underlying health of this market, Ben. That much we know.
Oh, for sure. Yeah, I mean, you think about, again, the push, the push that's happening right now, and it's same as it ever was, Kevin. I mean, the push was, into, self-driving vehicles before that. It was into Bitcoin mining rigs before that. It was into, whatever else. There's always, technology is always has been and always will be the perceived savior of humanity, right? That we're always going to pivot to a technology solution.
That's right.
Whether it's, whether it's the Terminator or whether, whatever it is, but technology is always driven by semiconductors. And so this has to be a component of your discussion.
It does. I'm not so sure it played out well in Terminator necessarily.
No, not necessarily. And hopefully we avoid that singularity.
That's what I'm hopeful of as well. I'm just hopeful that the powers that be are paying attention to all of our historical science fiction, because it seems to continue to play out every single day.
Well, the theory always is, Kevin, that science fiction is kind of the warning signs, 3 or 4, maybe 10 years ahead of what the reality of the situation is, right? So you gotta pay attention to that for sure. Yeah.
All right. One last thing we're going to look at is oil, Ben. There's been a nice pullback in the price per barrel of late. We had been talking about the huge push higher here into the 200-day moving average. And since I last spoke about this, with a little bit more detail, which was 2 weeks ago, we have pulled back pretty aggressively. back through what, again, I have drawn in as a green line, but given price action now, I'm going to have to color that differently. It needs to be a red line. We have now met resistance once more here at about 72 a barrel or so, being that we're back below it. And I think, Ben, if you're a bear on oil, you've got three things playing favorably here, one of which is the 20-day, we're under it.
Yep.
The other, the 50-day, and number three, the 200-day. We are under three major moving averages on the price per barrel.
Yeah, I think you're absolutely right here, running into that resistance. On the other hand, here's the thing, we're going into a period of time where typically, seasonally, crude oil prices are lower, but we've got geopolitical risk. We've got, growing geopolitical risk. At the same time, we've got potentials for negotiations and reconciliations going on. So this is a market that is reacting, I think, to this expectation of supply increase as opposed to supply constraints. And it's acting very, very differently than a typical geopolitically driven market would, running back up into this resistance level. That being said, I think if you look at the forward, and I know James talked about this, our good friend James Boyd, who's out here in the chat right now. I think James talked a little bit about the idea that there is some growing interest in the next couple of delivery dates in that crude oil futures contract. And not to get too deep into this discussion, but it's becoming a more normalized, backwardated market as opposed to a contangoed market. And so I think we're kind of seeing that play itself out. There's an expectation that crude oil prices are going to rise out into the future as opposed to seeing that push back down to the downside.
Yeah, just to give a little extra context there, as you said, Ben, crude inventory, according to API reporting, crude inventories rose 1.6 million barrels last week. Gasoline inventories actually fell 2 million barrels last week. Oil prices down more than 1%, with U.S. crude inventories swelling more than expected. So there you go. That's been a major play here. But yeah, the political environment there in the overseas is not is one we got to keep an eye on as it relates to oil. Obviously, we'll leave it at that. Yeah. Okay, Ben, what about some stocks in the news today? I know everybody kind of hangs tight and looks for stocks in the news. Let's start with the negatives. Unfortunately, we got to look at McDonald's, which is having a really rough day today, off about 5.5%. Pretty good move off the trend, as you can see here, everybody. The 20-day moving average working very, very well until today. The big news here is the E. coli breakout, according to I'm going to give you guys I'm sure I hit this properly, everybody. The Center for Disease Control and Prevention. So yeah, said an E. coli outbreak tied to the fast food giant's Quarter Pounders specifically, resulting in 10 hospitalizations and 1 death, unfortunately. So there you go. Big move here. They also today, Ben, were downgraded as a result. Baird downgrading and Guggenheim downgrading.
Just listen, just ask Jack in the Box what a little bit of E. coli will do to your profitability for a couple of decades, right? I mean, and from that perspective of the consumer has a long memory, there are people in my family, there are people in my house right now who will not eat at Jack in the Box simply because of that circumstance that happened 20 plus years ago. And so this could have some particular lasting results on and lasting impact, depending on, how McDonald's handles this from that perspective. Now, here's what I would like to see them do. And again, this is just the gospel according to me. This is not a recommendation, but James Boyd will agree with me on this. This is when they need to roll out all in on the McRib, as they typically do in November, to offset the impact from the E. coli. Just saying.
Interesting. Now, Ben, I got to point something out. Don't take this the wrong way, but that was 30 years ago, not 20.
Yeah, it was. Gosh. So look, I just dated myself, right?
No.
There you go.
I think we're talking like early 90s, 92 to 94, somewhere in there.
Yep.
I looked it up. It did say the numbers, by the way, were big. I mean, 600 people getting sick, but comparatively, that's a fairly small number. You're right. To carry the the negative sentiment associated with that for so long. I never even remembered why I was so negative on it until you mention it. But essentially, yeah, that's it. It's just one outbreak and boom, it can be over for many, many people.
But Kevin, on that point though, think about this. Think about the fact that we've now seen. I mean, it seems like every other day, we get some kind of food health scare, right?
Yeah.
And so I think maybe we've kind of entered that realm of food safety fatigue, right? We hear about listeria, we hear about all of these other things that have happened, and yet at the end of the day, quarter pounder tastes pretty good, and so we're typically willing to overlook that, right?
Yeah, it is unfortunate that it does. I try not to let my decision making be ruled by my stomach, but I'm not as strong as I once was. Since we're talking downgrades, I just want to put one more on the table for you, everybody. Enphase today downgraded. So there's been some discussion of concerns relative to this space in particular, which has changed quite a bit from a trend standpoint, Ben. But Enphase was downgraded by Guggenheim to sell from neutral. New target here at $73 a share. That'd be about a 10% sell down from the current price. And they were stating that following the release of the company's Q3 report, results and outlook underscore their competitive strength in the market, in the U.S. market, but also its significant challenges in Europe specifically. While stating that it's true Tesla poses a growing threat for the storage-attached segment of Enphase's business, this is already showing up in results. It is arguing, Guggenheim is arguing that there is a growing disarray and a lack of progress from aspiring entrants that leaves Enphase plenty of room to operate in the U.S. But again, the bigger issue being specifically the Europe exposure that they may have. But Ben, when you look at the chart here, this is not a great look of a stock that is making what you thought might be a bottoming pattern. But my goodness, we have to test that 73.5 low?
Boy, it seems like it wants to, right? I mean, but look at that. Once, twice, 3, 4, 5 times bouncing off of that support level, and then we get a final that break there. And over the course of that time, I mean, you had it moving down. You had that RSI moving down. You had some mixed earnings results, but boy, there it goes all the way down to that bottom. Now, there were, think about it in terms of symmetrical moves. If we were looking at the range that it kind of channeled in during that time frame, that's about where, maybe just a little bit lower, where this bottom is, and we could see a reversal at that point.
Good reminder. Yeah, the range we were looking at close to 140 down to 100 or 95. Oh my goodness. So that is not ideal. The one thing we could be looking for, Ben, is a shift in price action with all the negative news continuing. If negative news continues and you see action change, that's one thing that could be a signal that maybe things are turning for it. But nonetheless, on a weekly look at this, very important zone of short-term and longer range support down there with today's approximate lows. Not a great look. By the way, they were also downgraded by Janney Montgomery Scott to neutral from buy. So there's been a couple of downgrades there. What about something a little bit better? How about we talk upgrades, Ben? How about Texas Instruments? Texas Instruments got upgraded by Summit Insights today, upgraded to buy from hold. The company seeing a cyclical recovery in their PC, smartphone, consumer, enterprise systems, and communications infrastructure end markets. So a nice headline, at least, up 4% today, Ben.
Yeah, actually, I think that's a nice little kind of hammer candle bounce here off of that support level. We get a little bit of a run to the upside on this move today. It'll be interesting to see if it can kind of break out of this just slightly rolling over sideways channel or downward channel that it's been in. But I'm hearing other things, not only in this earnings announcement, but elsewhere and with these analyst reports, that there is kind of this longer term change back into the PC market, into technology again. And certainly, you would think about that from the perspective of companies like Apple and others that are rolling out new hardware initiatives. But Texas Instruments, this is how it starts, right? It's got to take a couple of the smaller players to start announcing their earnings and driving that guidance higher. That's maybe going to shift this market again back to the upside.
Yeah, Ben, sometimes we got to take this back to a longer term view and kind of filter out some of the noise. And this has been a weird looking process here. You had the break of this very deep range, 30 plus point range, broke to the upside. And then we've just been in this, some would call it a flag because it kind of looks visually like a flag. But we've perhaps given up more than what many traders would like to see. So, Ben, if you're looking at this from an entrance standpoint in terms of trend, you don't have, on a longer term pattern, you don't have an entrance point just yet, do we? I think for a lot of traders, it would be taking out the downtrend line that would give them the comfort to be entering a new position here. Your thoughts?
For sure. Yeah, absolutely. You could also look at it from the standpoint, and I taught this a couple of weeks ago in my flag patterns class, the idea of looking at weekly types of flag patterns. So whether this looks ideal as a flag, it still has some of those elements of a flag. So you might look for a close above the high of the low week.
Sure.
Somebody coined it a cahowl. I know James probably is rolling over here, but instead of a cahold, close above the high of the low day. So maybe looking for a close above the high of the low week, which coincidentally would be likely right about at that diagonal downtrend line. So you got to see some kind of movement above that area of resistance that's been tested once, twice, 3 times now as a resistance level in that diagonal downtrend to maybe see some significant move higher.
So let me just throw a couple extra contextual pieces in here for you, everybody. Barclays did adjust their price target on Texas Instruments to $200. Previously, it had been at $210. They maintain an equal weight rating on the stock. Baird analysts lowering the target to $175. Previously, it had been at $200. They maintain a neutral rating on the stock. So just all of the detail associated here with Texas Instruments. Wanted to make sure you all had that. And then, Ben, I thought the last one we would look at from a standpoint of underlying or individual equities today would be Starbucks, because I just got done talking about how price action can give you a little bit of a leading heads up, particularly when news isn't ideal. And the news on Starbucks today is they suspended their guidance for fiscal year 2025. Ben, typically that is not a positive, and yet the stock, while it opened weak, it got buyers down there at about 94, didn't it?
It did, and pretty significantly today, right? Pushing that back up and not breaking. Look, we got this little kind of island up here after that moved to the upside, and that oftentimes. So pay attention to, if you're looking at Starbucks, that 90 support level, because if this reverses, if this is just a short-term bounce looking to get out towards these highs here in the 96, 97 range, but watch that 90 support, because if this starts moving down towards that 90 support, especially on once the earnings announcement does come out, right, which is just over the horizon here on the 30th, the day before Halloween, this could be a Halloween surprise, and we could see an island reversal that could take this price down significantly, right?
Yeah, and then the last note about that, Ben, is why did the stock make the gap move it did? This was all this whole gap began with the shift in the CEO. They changed the CEO. And Ben, you have to take context with these moves. And yes, it's a gap level. You could just eliminate the reasoning and say, okay, it's a gap level, very important. But it's a gap level on big news, a shift that the underlying investors believe to be positive for the company moving forward. And the takeaway to this point to me is, hey, the underlying shift to CEO is perhaps the most important change that the company has made, regardless of this removal of guidance for 2025. So yes, this is not and again, this gets back to my point, not a great piece of data today, and yet the stock is not collapsing, Ben. That is a shift in what has been happening.
And maybe investors, because of that CEO's reputation at Chipotle, are willing to give him maybe a little bit longer honeymoon period to work his potential, not a guarantee by any means, but his potential magic in driving this higher, and that's why they're not pushing this back down as low as they are. They're still buying those dips, at least in this particular case, and pushing that price up. And maybe the suspension of the guidance is simply working through the process of righting the ship or getting the steam up to steam in the espresso machine, right?
That's right. That's a good, nice little analogy there, Ben. Perfect. Perfect as per usual. Man, one thing we can guarantee when Ben and Kevin get together, we're going to have some analogies that are going to be
sure
born. We're going to hear maybe some musical quotes out of Ben. You're going to get some lyrical assignments here. You can also get some movie quotes. It's pretty consistent, Ben, as always. Man, I love being on with you. Thank you so much.
Oh, great stuff, Kevin.
Here, sharing your thoughts and insights with our viewers today, Ben.
You bet. By the way, speaking of that, share your insights and views with us, because we've got a feedback survey out there in the chat.
Good.
And let us know what you think and how we can make these sessions better.
Thank you, Ben. Really appreciate that. And to all of you, yes, take them 2 minutes if you have it to tell us what your thoughts are on Trader Talk in particular. We appreciate that. Follow the three coaches here on X at Kevin Horner CS, at Ben Watson CS, at James Boyd CS. And if you like today's segment, hit that thumbs up for us down below. It helps us out in the algorithm as well. So thank you, JB, for reposting that survey link there. We'll say wrap it up there for today, but I will be back a little bit later for that trading breakout patterns. If you have the opportunity to join, that'll be at 1 p.m. Eastern. Outside of that, reach out to us on X as you'd like. Everybody have a fantastic rest of your Wednesday. We look forward to seeing you all again real soon.